Hi everyone, George here. And before I go any further, I'm not an accountant, a CPA, or a tax lawyer. The opinions expressed here are my own. Definitely do your own research. By way of taxation, I'm self-learned. I was a prior H&R Block tax instructor for the longest time. I've had a nice career in taxation, preparing T1 returns, some 1040s. That's American. Don't do those anymore. And some knowledge of corporate and tax law, but nothing to the level of making me a tax lawyer. I just wanted to do a quick video, an overview of the tax changes. It will include some Quebec tax changes, but I'm planning to do a separate video for Quebec as they have we have our own separate returns. I'm originally from Quebec. I'm here in Quebec now, so I think Quebec merits its own video. So on with the show. Federal. Well, with federal government, we have changes to the alternative minimum tax. They increased the minimum tax rate, the exemption threshold, including the calculation, the special foreign tax credit, and the minimum tax carryovers. So for those of you that don't know what the um, alternative minimum tax it is for individuals that engage in certain transactions. These transactions, usually they're high net worth individuals, but not necessarily so. Uh, they trigger the alternative minimum tax. Now you can avoid it by effectively tax planning and trying to avoid making those transactions in the first place that would put you in that predicament. However, if you are inflicted with alternative minimum tax, the thing that you need to remember is that the amount that you pay can be carried forward 7 years and then applied against regular tax. So why did alternative minimum tax come into play in the first place? Well, decades ago, we're talking about the days when Ed Broadman was the leader of the NDP. And there was a notion that you know certain high net worth individuals don't pay their fair share of taxes compared to the rest of the people, so there should be a an amount of minimum tax those individuals should pay to put them on an equal footing with uh, more less fortunate individuals. Um, However, the way the system was designed was that okay, you incur this minimum amount. However, ideally, there should not be a system of double taxation. Therefore, you are going to pay this minimum amount because you engaged in these activities. However, you can carry it forward 7 years to use it against regular tax. It's a bit like catch and release when you're fishing. Oh well, can't judge that. Let's move on. All right. The other important change that you need to know about, well, Lord forbid, your child passes away, and we're talking about a child less than 18 years old, and you're receiving in Canada a child benefit for it, it will be extended 6 months after the date of the death. However, you still need to notify the CRA in case of death. The same holds true for old age security, meaning that if a person passes away, you should notify Services Canada as quickly as possible. Now, the Canada Pension Plan and Quebec Pension Plan enhancement. So there is an enhancement, it's an additional contribution, it's for people middle to high income. It's maxed out at $188, um, and it's supposed to enhance your pension once you retire and decide to draw on it. And for 2025, the amount will go up, but we're still talking about a couple $100 or so. The other important change is that now for Quebec, Quebec has decided to follow the example of the Canada Pension Plan and allow taxpayers 65 years or and over. Mind you, there is a cap as to uh, an age cap where you can no longer contribute to the um, Canada Pension or Quebec Pension Plan. I think it's around 71. But in that age threshold, if you are receiving the Canada Pension or Quebec Pension Plan, you can opt out now from both contributions. Mind you, you have to be receiving the pension in order to qualify and be at the right age threshold. So what does that do? Well, what does that do is for people that don't want to give their contributions to the Canada or Quebec pension plan, you take more money home, and hopefully you'll invest that money in another retirement plan like a RSP instead of going with the government plan. Mind you, here in Quebec, the Quebec pension plan management has been, to my knowledge, excellent, and folks receive a modest but a good pension, and they have something to fall back on in their retirement years instead of absolutely nothing. Now, you might be wondering at this stage of the game, 6 minutes into the video, why is he doing a tax update so late in the game? Well, this is one reason why. With the capital gains inclusion, the increase first was canceled. I'm talking about a capital gains inclusion, not a tax rate. Two different things. I'll explain to you that later. So it's been canceled, but consequently to that, um, here's the story, okay? Let's start from the beginning. The beginning starts in 1971 when Canada decided to tax capital gains to begin with. And that's if you have an asset that you've held for longer than that time or around that time, you have to look up the VDA value to understand what is the cost, the difference between the proceeds and the cost in order to claim your capital gains. And the reason why traditionally Canada has not taxed capital gains is because people that invest in capital don't have a surefire guarantee that that investment will pan out like a pan of gold. But even with gold, the price fluctuates up and down. So you invest in a capital asset hoping it will appreciate in value. There's no guarantee it will. And in the meantime, there's also no guarantee of an income. So you're assuming a certain amount of risk, and that risk grows over time, especially in an inflationary environment. So what's the use of taxing capital gains? It impedes investment to some extent. People will have to think about the after-tax consequences before throwing money down on the line. And when you are talking about capital gains, you are talking about investment in capital assets, meaning there is a potential that that investment will create employment and wealth, not only for the individual, because once the individual acquires that wealth and cashes out on the gain, they're going to probably share it with other individuals. Anywho, as you know, in terms of generational fairness and other reasons that were bestowed upon the government uh, at the time when Ms. Freeland was finance minister and Mr. Trudeau was the prime minister of Canada, they came up with a slew of reasons as to why they wanted to increase the inclusion rate for individuals over 250 with income over 250,000. There was a lot of setbacks and criticism of the government at the time, not only from the conservatives but certain professionals like doctors and nurses. And basically, the crux of the matter was that measure was not introduced in a timely fashion. Um, Ms. Freeland chose to delay it, so it would be a separate motion to embarrass the conservative opposition into voting against it. And then the little conflict between Ms. Freeland and Mr. Trudeau transpired. But before that, the measure was never passed due to that delay. The CRA decided to enforce it because there was a ministerial note with respect to that. But then accountants, having already incurred in the prior year a setback with the trust changes, decided to take the government to court and said, you know what, we can't incur any more pain on behalf of our clients. Do what you may, but this is how we feel about it. And then the CRA backtracked. That meant that we had to redo some work with respect to the capital gains. And lo and behold, this retooling of the capital gains inclusion rate has resulted in some delay in the government forms. And we just found out through global news last week that the capital gains, people with capital gains, will not incur interest and penalty on tax owed until June 2nd for T1, that's individuals, and May 1st for trust filers. Interesting. So, more or less, for the individuals that incurred capital gains or losses, since you have to declare them on Schedule 3 on the T1, any interest and penalty until June 2nd on your tax owing. However, they didn't change the tax filing deadline. The tax filing deadline is still April 30th for individuals and without a business, and June 15th for uh, people with a business, a T125. The Rural Exploration Tax Credit extended one more time. Just tell us when it's not going to be extended. Reporting rules for digital platform operators. Sellers should report their income. Digital platform report your activity to CRA. Special rules since January 31st, 2025. So again, the liberal government took aim at Facebook and other uh, media platforms, digital media platforms, with respect to a digital tax, with respect to paying for content providers that are small news Canadian small news organizations. As a result of that, Facebook decided not to allow users to share Canadian news content on their platforms. But what this is talking about is if you're selling on eBay, uh, from a business perspective and or Facebook Marketplace, there there appears to be rules that the that platform should be collecting your probably your social insurance number and your activity and reporting your sales to the CRA. Now, I am not sure how that would pan out, but from a compliance perspective, meaning if you want to be above board, that's what I mean by compliance. If you want to be above board, and you should be above board, if you're engaged in uh, a gig or a or getting contracts uh, off of different online platforms, or even selling at a business level online, you shouldn't have to be under the cloak and dagger of the CRA to report your activity. You should be readily declaring your income and expenses, doing a business income statement. And the benefit to that is, first and foremost, you're increasing your RSP deduction limit because your net income will count towards that limit. And secondly, if you want to go and get a loan or improve your credit, you have to show that you're capable of paying back a loan. So if you do have a business, it's to your advantage to pay the tax on your income and declare your income. And that's not a bad idea. Short term rentals. As of January 1st, 2024, no longer able to deduct any expenses for non compliant short term rentals. Now, what does non compliant short term rentals mean? What that means is that people are going a little bit crazy with Airbnb and other online platforms where you rent a room and whatnot. People were not declaring their income, or they were renting where in zones where you're not allowed to rent. They were practically making livable um, livable long-term rental locations into hotels, and in some cases um, bed and breakfasts. And they weren't checking the bylaws, I guess, for that and whatnot, and everything was a black market. Now what they're saying is, if you are running such a rental that is not in a zone that is permitted by municipal or provincial laws, then your expenses will be denied. So that has resulted in restructuring the statement where you report your um, income, and they're asking for minute details with respect to that. Um, if I had a property which I would rent, I would strongly recommend first, you know, checking with your municipal government to see, am I allowed to do this with um, according to the bylaws of my township, county, city, village where I live? Am I in? Am I doing anything wrong? If you don't want to contact a your municipal government, reach out to a lawyer and make sure that you have a sound business plan, that you are in compliance with the law in doing that activity, and report your income. That's all I can say. Um, with respect to the fighters amount and search and rescue amount SRVA, there was an amount of 3,000 um, that has increased to 6,000. Now, the 3,000 and 6,000 may sound like music to your ears, but it is a non-refundable tax credit. And with respect to this credit, what we're talking about is there are a certain amount of income that can be earned and excluded from income. However, there is an optimization to be made, a choice to be made by your accountant or by yourself or by your tax software. In UFAO, it's done automatically where you can include the income and consequently claim this non-refundable tax credit, and you do whichever is best for you. And if you have a reputable software like UFAO, it does that for you, that choice for you. Alberta, now we're past the federal government and onto each province. Alberta, let's not forget about Alberta, indexation of tax brackets and most non-refundable tax credits, and you're no longer able to carry forward Alberta's investor tax credit from a previous year. Then British Columbia, of course, there's always indexation of tax brackets and non-refundable tax credits, except for a few provinces. And the following credits have been extended: the training tax credit for individuals, the training tax credit for employers, shipbuilding and ship repair industry tax credits, and they each have a different deadline. So the first one until December 31st of 2025, the second December 31st, 2027, and shipbuilding and repair industry tax credit December 31st, 2026. I'm glad that these all these credits expire on my birthday. Manitoba, your normal indexation, the maximum annual amount of eligible expenses for fertility treatment tax credits have changed. So pick up your guide, take a look at that change. Calculation of the education property tax credit and the school tax credit for mobile owners has changed. New Brunswick, there's the normal indexation and the introduction of the volunteer firefighters and search and rescue volunteers tax credit as of January 1st, 2024. I have Newfoundland here twice. I guess once for Newfoundland, once for Labrador. Just normal indexation of tax brackets and credits. Nova Scotia, I don't have indexation here. Anyway, indexation, no extension of innovation tax credit to March 1st, 2029, and the venture capital tax credit has been extended to March 30th, 2029. Now, with venture capital tax credit, I'm not certain if they're talking about labor sponsored tax funds or not, um, but there has been a bit of controversy with respect to labor sponsored tax funds. That's when unions invest in small businesses in province in order to increase investment and and employment opportunities. Nunavut, just indexation of amounts and credits. Come on, Nunavut, you can do better than that. Anyway, Ontario, indexation of tax brackets and non-refundable tax rates, and the AMT rate is reduced. AMT, remember, that's alternative minimum tax. PI, Prince Edward Island, tax brackets and non-refundable tax credits were indexed. Two additional tax brackets and I guess an eliminate. Okay, so there's two additional tax brackets, and there was an elimination of the 10% surtax. So if you can imagine that your PEI 428, there's um, about 5 columns and 2 rows now. Right. Income threshold for the age amount and low income tax reduction have increased. Children wellness tax credit increased from $500 to $1,000. And the Prince Edward Island benefit has been introduced, new for 2024. Saskatchewan, other normal indexation tax credit rate for other eligible dividends has changed. All right, and Yukon, is that my last one? I think this is my last one. Yes, it is. Yukon, indexation of tax brackets, non-refundable tax credits. Remote supplement for the Yukon government carbon price rebate for individuals has increased from 10% to 20%. The placer mining adjustment factor for the mining business rebate has changed from 4 to 2 for tax years ending after March 31st, 2024. Heck, I would love to visit Yellowknife and go on a mining safari, find a couple nuggets of gold, and come back here and enjoy life. Ladies and gentlemen, that was my 2024 update for Canada. Quebec will be another occasion. Stay tuned. I hope to get more videos done. Like and subscribe, and do tell your friends about it. I don't post often, hardly at all, but I do have links to my previous long segment of um, UFile videos I did long ago. Some of the tax knowledge is still relevant. I highly recommend that you look up find that playlist on my channel and go through all of them. Take care. Have fun.